How do you figure out the right investment mix to accomplish your retirement or other financial goals? Welcome back, and in today's video, I'm going to explain how to figure out the right investment mix to accomplish your retirement or other financial goals. The number one driver when you're trying to figure out, how should I invest to accomplish something is going to be the time frame. When are you going to need the money? Are you going to need the money for a purchase that's coming up in the next couple of days, months, weeks, year? Or is this a goal that you probably won't, you're not going to need the money for years or maybe even decades into the future? That's going to be the number one driver for how you should invest. And when we jump into this conversation, talking about time frame obviously, but a couple of just kind of baseline foundational principles here. Talking about the stock market and the bond market and everything, I'm talking about diversified portfolios here. So I'm not talking about, when I say investing in the stock market, I'm not talking about betting everything on a single company. Regardless of the time frame, if you're trying to save money for a particular goal, betting on a single company is extremely risky and probably not a great idea. So I'm going to jump into a chart. I love this. It's put together by JP Morgan, and it really breaks down historically how different investment mixes have performed over different time frames. And not only their performance, but it also helps really illustrate kind of the range of outcomes that you can expect. And understanding kind of the worst case scenario or kind of best case scenario historically, that range really gives someone a lot of insight when it comes to figuring out how they should invest and what they might expect. So let's jump into it. Okay, so on this chart, we're looking at three different portfolios. We're looking at a portfolio of 100% stocks, and this is really just think about investing in the S&P 500. We're also looking at investing in diversified bonds, and then this gray one, this is looking at investing in a mix, a 60-40 mix. This is pretty typical of something like a balanced portfolio. That's a term you'll hear thrown around. And looking from 1950 to 2023, you can see that on average, the returns for each of these portfolios have been pretty great. 11, 5.5%, 9% per year. Those are pretty outstanding investment returns. So on the chart, though, down here below, we're going to be looking at different time frames to see how these different investment mixes have performed. And you can't really see it because my little picture's in the way here, but this is 20 years. So we're going to see how these performed over any given 1 year period of time. So between 1950 and 2023, that would be 73 different 1 year rolling periods of time. And if we're looking at the green bar here, what this is showing us is that over any given 1 year period of time, investing in January and then selling your investment in December, on average, the average return has been 11% per year, but you've had years where you've lost 39%, but you've also had years where you've had a positive 47%. So, let's say you're saving and you need money for something at the end of the year, right? You're going to buy a car at the end of the year. You need $50,000 set aside from your investment portfolio for your first year of retirement. How should that money be invested? Well, if we were just planning using averages, 11% per year, that sounds pretty great, sounds good. But there's a big difference between the average return and then what you might expect from year to year. So over a 1 year period of time, a goal for over that short period of time, stocks, I would say, it's like an extremely risky proposition that you're making. Your range of outcomes anywhere between, positive 50 and negative 40. I mean, that's huge. Now, you can see with the different investment mixes here, the expected range of outcomes really narrows, right? So with bonds, kind of the worst 1 year period of time we've ever seen is a negative 13%. And as good as positive 43. And with the diversified portfolio, I love this. It really illustrates the principle of diversification and how it can not necessarily improve returns, but it can reduce risk. Or in talking about risk right now, we're talking about the range of expected outcomes. If I invest today, some money, what's realistic? What could I expect a year from now? And you can see that the expectations narrow from positive 40 to positive 47 to negative 40. All the way down to positive 34 to negative 20. Okay, so as we look at longer time frames going out from 1 year to 5 years to 10 years, let's just jump ahead to 10 years. So if we were to invest money in the stock market and hold that for 10 years, between 1950 and 2023, how many 10-year rolling periods of time have there been? There have been a lot. What have been the range of returns in the stock market? Well, believe it or not, there's been the highest that you could have gotten was 19% per year. That would be pretty awesome. But there's actually been a 10-year period of time, over that range where you could have invested and your annualized rate of return over 10 years would have been negative 1%. So So still, is that likely? I'd say it's less likely, but I think this is a good idea. I mean, it gives us a good sense. This is a kind of worst case scenario. Now, if we look at a diversified portfolio, mixing stocks and bonds together, your worst 10-year rate of return has been 2% per year, right? So nothing like very exciting or particularly great, but now all of a sudden, if we had a goal that for something 10 years from now, and somebody wanted to invest in a diversified portfolio of stocks and bonds, I would say at this point, they're not being foolish, right? I think it's reasonable to expect a positive rate of return. So a little bit of insight there. Now, looking at even further, if we go out 20 years, and you can't see it because my picture's here in the way, but the worst annualized return for the stock market over rolling 20-year periods of time has been 6% per year. So now, if you think about it, if you're saving for something that's not going to, you're not going to need the money for 20 years, all of a sudden, given the different options you have to invest in, keeping your money in a savings account, investing in the stock market, or some other kind of equity-like investment, all of a sudden, stocks go from being, what over a 1-year period of time was extremely risky, to being probably the least risky proposition, or option to invest in over that time frame. So coming back, when it comes to investing for a goal, the first thing to think about is, when are you going to need the money? If it's money that you're going to need to spend like a year from now, that money needs to be set aside in a very conservative way. So this is whether, let's say you're in retirement and you're going to retire in a year from now, it makes sense to begin setting aside some money that is just, let's assume that you're going to be spending from your portfolio. So if there's money from your portfolio you're going to spend, it's going to make sense to start setting some aside that is extremely accessible and conservatively invested in a money market account or something, or short-term bonds. And on the flip side, retirement is a long period of time. For some of us, it could be 30, 40 years. And especially if you're retiring early, your retirement could be even longer than that. With that being the case, in order to have inflation-adjusted income and growth of your portfolio over time, you're going to have to invest in things that can do better over time. And a diversified stock portfolio, over the long run, is shown to be one of the best options.